coming here today. This is our last online session, at least for this semester. We are going to start again in second semester with some other conversations, but today we are basically finish up some of the online sessions that we normally do with our aspiring investors. And today, as always, I have my dear friend and venture partner Alejandro Vivanco. He is going to do this presentation, which is introducing to the venture capital cycle. Alejandro, I'll pass it to you.
Yeah, so thank you, Miriam. Welcome back, everyone, for the last session of our Introduction to Venture Capital series. This is online session number 2. So last week, we essentially went over valuation and deal structuring. So today's session is really going to be focused on how do you look at venture capital as a whole once you've done your investment, once you've executed, due diligence and so on. So this is going to cover what happens once you've deployed an investment, how do you exit, and what are the expected returns or different exit scenarios that you should be expecting, or how do you even work towards an exit? Because that's pretty much, I think, the most important part of doing venture capital. Once you've invested, you obviously want to generate and see meaningful returns. So this is what we're going to cover in this session. So the agenda for today is threefold. So we're going to cover follow-on investments, just to talk about what they are, why investors pursue them, and in what situations these follow-on investments, which are additional flows of capital into your existing portfolio companies, when do they make sense? Then we're going to be looking at exits, like I said, and then we're going to go through a very, very simple case study to paint the picture around what it looks like when it comes to returns and fund performance of a venture capital investment. So to get started, for follow-ons, it's a very, very simple thing to understand. Like I said, it's just additional capital being invested into existing portfolio companies. And there's a couple of different reasons why you would want to do these things. Number one is to continue supporting the growth of a startup company. So any startup, will continue requiring capital. They will continue growing. You obviously want them to grow in order to for them to increase their valuation, increase their metrics, be more appealing for future investors. So that's a natural purpose as to why an investor would decide to put in more money into an existing investment. The other one is maintaining ownership percentage. And this is important because when companies go out and raise additional rounds of capital, your investment, so let's say you own 5% of a company and then it goes out to raise more, let's say 1 or 2 more additional capital rounds, your 5% doesn't remain 5% forever. It can be exposed to what we call dilution, which means more capital being injected into the company by additional investors means your portion of your stake becomes smaller and smaller. So to maintain your ownership percentage, you would essentially put in additional money in order to protect that. If you want to maintain, of course, a given percentage. So that's another reason why follow-on investments would make sense. And the other one, which a lot of people also tend to not think about, is to signal confidence to other investors. So in the same situations, like I mentioned, where companies go out and raise another round of capital or additional rounds of capital, they will often investors will want to know, for example, if the previous investors are still participating in this new round. And so you, by being an investor in it, if you're participating in a new additional round from an existing portfolio company, it can help signal confidence to other investors that this is still something that you believe in and that you're willing to put in more money into it. Now, in some situations, it might not make sense for you to do this, but it's just something to keep in mind, because it's little signals like this that other participants in the ecosystem will also pay attention to. Now, in terms of investment strategy, so again, this is pretty much related or overlapping what I just mentioned in terms of why an investor would do this. But here I want to just paint a clear picture as to what are the different motives, or at least strategies that investors would use when pursuing follow-ons. So the number one, like I said, is pro rata rights, and this is really around maintaining the ownership percentage. Number two is doubling down, so increasing your the stake that you have in your high performers. And this is more so, for example, when you have a pool of 20 portfolio companies, for example, and as time goes, you start noticing which ones are likely to have, bigger exits and so on. This is where an instance in which you would double down, and this is more so in order to manipulate in a way the returns of the entire portfolio as a whole. So in other words, when you see one investment or a few investments of these becoming high performers, you naturally would want to increase your stake in order to make sure that the returns that you showcase to your LPs, to your other investors at a portfolio level become much higher, right? The number three is going to be defensive investments, and this is more around protecting existing investments. And this can be either from competition, this can be from, certain things like, avoiding them, going bankrupt, for example. But I think it's more so from a perspective of competitive threats. So a good example that I like to provide is at the time that, for example, Uber and Lyft were coming up in the market, whoever it was, the investors that were behind both of these investments were acting in a way that was to protect their respective investments when it came to providing more capital to these companies so that they can compete against each other. And this is more so, for example, they were trying to outcompete each other in terms of marketing and in terms of also hiring. So the more capital that they can have access to, the quicker that they can move and grow. And ultimately, one of them would take a leadership position. And in this case, it's Uber. So again, it's just a way for investors to make sure that their existing investments, they're doing well and so on. But other competitive threats, they're at risk also of potentially disappearing if somebody comes in and outcompetes them, either from a spend perspective, marketing perspective, whatever it is. They want to make sure that their investment is protected, so they would inject more money, basically at all costs, growth at all costs. And the last one is going to be bridge financing, and this is also very common to see out there. And this is more so to support an existing portfolio company between funding rounds. So in some cases, as you may be aware, raising capital takes, anywhere between, 6 to 12 months, again, depending on the company. But I would say the earlier that you are, in terms of basically the stage at which you're at, the earlier that you are, the longer that it will take. And so for existing companies that are looking, let's say, to raise their Series A or Series B, for example, sometimes it can take maybe a few more months in order to raise or finalize an existing deal that they're working on. So, but at the same time, they still have expenses, right? They still have expenses to incur. They still have cash that's being burnt as a company operates. So this bridge financing tends to be sort of like that in between, where companies get access to some sort of capital in order to cover a specific gap in time that they have. And bridge financing, so therefore, tends to be more on the debt side. So maybe you can see some convertible notes, maybe just a straight loan as a whole. but it's still an investment strategy that investors will be aware of or watch out for. Now, obviously, when it comes to follow-on investments, like I said, you don't have to participate at all times, and sometimes it doesn't make sense for you to do so as an investor. And what I always tell people is any follow-on investment decision has to be treated exactly the same way as your initial investment decision, meaning that you still have to do due diligence on the company, right? You still need to make sure that, okay, is this company still tracking against their KPIs? Because you want to make sure that this is not more risk that you're being exposed to when it comes to your portfolio. You want to make sure that your assumptions or the potential of the company also has not changed. Is the market traction that they have still under good momentum? Is the growth potential still appealing? So you want to pay attention to those. And also, again, has the competitive landscape changed? Because things can change super fast, in a good way or in a bad way. So you have to still make sure that these things make sense for you as an investor. And of course, the last one is always, the capital needs and runway extension of the company, meaning that is this company, besides the money that I'm going to put in now, is this company, how much more money is this company going to require in order to hit their, next milestones, and how much runway is this actually providing them? Because let's say if a company comes to me and asks, let's say $100,000, right? Does that mean that $100,000 is giving them 6 months of runway, or is that 1 month of runway, for example? So you have to pay attention to those things as well, because, again, sometimes your capital may not even, make a dent in the trajectory of the company. So it wouldn't make sense for you to, deploy that additional capital if at the end of the day, it's not going to change much. Any questions for this section before we jump to the exits portion?
I don't see any questions for now, Alejandro. We can continue.
Okay. So in terms of exits, so we have a couple of different exits, and maybe some of them you're more familiar to than others. Obviously, I think the more popular one, or the one that's most widely known, is the IPO, initial public offering, which is when companies go and list on the stock exchange. However, for our purposes, again, focused on the early stage VC space, we're really going to focus on the three others, which is going to be acquisitions, secondary sales, and management buyouts. So all of these different exit types obviously are possible, and they will always depend on different things, like the market conditions, right? Are companies, investors in the market excited about, this particular industry or these particular type of companies? If yes, then that's a good time, because valuations tend to be, high or trending higher. But at the same time, or on the opposite side of things, if investors are more pessimistic, and it doesn't have to be necessarily because of the industry per se, but just in terms of like the economic environment as a whole, then valuations will obviously be maybe lower. So this is something that you have to consider. As well is the company readiness. Sometimes, companies are not ready to go IPO, for example, or they're not necessarily ready to be integrated into another company, right? Maybe they don't have the right profile. They don't have the right profile for somebody to come in and be acquiring them, right? And in terms of fund life cycle, this is also something to consider. So, as an investor, you don't have forever. You want to exit your investments at a given time, anywhere between, let's say 5-7 years, and then most funds have a cap of 10 to 12 years. So if you're, let's say, in year 9, you're not really in the best position to have a choice in terms of what type of exit you would like to execute. You really have to work with, okay, well, we don't have much time, so we have to look for an exit, and which one is it going to be out of all of these scenarios. So sometimes these scenarios won't even be available to you depending on the situation. And of course, the last thing is the return potential. Each of these scenarios will have a very different return potential simply because of the nature of how they work or who's participating in them. So this is something also that you need to keep in mind in order to have realistic expectations as to what to pursue and what you're going to get out of it. So the first type of exit, and I think this is probably one of the most popular ones after IPOs, of course, or the ones that, and by popular I mean that people know of, because again, all of these exit scenarios can be or happen at the same frequency. There's just so many transactions out there, but this is probably the one that people know the most of. But acquisitions can be broken down in two tiers. One of them is strategic, the other one is financial. Strategic acquisitions is basically what we typically hear of, which is companies acquiring other companies because they want to integrate them into their existing products, et cetera, et cetera. And the financial acquisitions tend to be essentially entire or wholly, well, both of these acquisitions are entire, but these acquisitions tend to be more from a perspective of acquiring the company in order to continue operating it. But the investors are really focused on financial returns. So they want to optimize the company. Maybe they want to merge it with another existing company that does maybe the exact same thing, and they just want to make it into a bigger company. So these types of buyers tend to be private equity firms or holding companies and so on. And all they're looking for is, additional cash flow. They see maybe growth potential into the industry, and they want to just be part of that. And of course, make sure that or increase the value of the company in order for them to sell it later on to somebody else at a much, much higher price. But as a VC or as an investor, your role in this case is really around facilitating introductions and helping maybe the company negotiate terms. So always be on the lookout for potential acquirers for your portfolio companies or potential investors that might be interested in this particular space. Because again, when it comes time to sell or generate that exit, you don't want to be caught into a position where you don't have options. So you want to start thinking about those options as soon as basically you've invested in them, and try to generate opportunities for the company for the long term. Now, the other one is secondary sales and management buyouts. I bucket all of these in the same category. They're different, but I bucket them in the same category simply because of the nature of the transaction itself. But so secondary sales is about selling your shares to other investors. So this is basically, it doesn't require a company to generate necessarily an exit or raise additional capital and so on, but it's more so on you to find an investor and see, okay, do you want to buy my stake in this company? And if so, you're negotiating that price with them. So they're not in touch with the company whatsoever from a perspective of negotiating the deal itself. In terms of due diligence, of course, they may be, but in terms of negotiating the deal itself, that's going to be with you. The other type of option is going to be management buyouts. And this is where company executives themselves purchase your investment stake, right? So for example, in a situation that maybe a company doesn't want to go out and raise additional capital, then you're really left with only a couple of different options. So as long as they're in the position to actually purchase the shares back from you, that's a viable option as well. And the last one is recapitalization. And recapitalization is, I guess, similar to management buyout, but the only difference is that the entity buying your shares would be the corporation itself. Capital in order to purchase back any any outstanding capital that other investors own, and that becomes back into equity in the company. The consideration also that you have to keep in mind as you go through this process, especially for any of these three, whether it's a secondary sale, a management buyout, or a recapitalization, is that you're not required to go through a full exit, meaning that you don't need to sell 100% of your stake. It can be partial, so you can sell 25%, you can sell 50%, any percentage that you'd like. And the reason why you would want to do this in some cases is simply because of maintaining your upside potential. So in some instances where maybe you've had a good run, you want to sell just a little bit to not only cover your basis, meaning recover the initial investment that you've put in, and maybe some additional money as well. But at the same time, keep some sort of equity participation in it for future. Maybe that you'll be able to wait and hold for a longer term. And if you're excited about the company, this is not something unusual that you would pursue. Now, in terms of planning for exits, the best thing to do is obviously starting early. And I would say, anywhere between 12 to 24 months before your target exit. So what I mean by this is, for example, if you execute an investment and you think, okay, you know what, I expect to be in this for maybe 5 to 7 years, just know that at least 24 months before that, you need to start thinking about, okay, what is the exit going to look like? Talk to management as well in order to know what are the options on the table, right? Are we going to go raise an additional round of capital? And if not, what are the options that they're looking to consider in order to help you as an existing investor generate that exit? Obviously, and preparing the company from a financial standpoint, making sure that financials are audit ready for whoever is going to come in. Also, from a perspective of strategic positioning, making sure that the company in itself looks good from a perspective of essentially to a new audience of investors. And this is why you see so many companies sometimes go through, for example, rebranding efforts or things like that, where the purpose is to present the company or refresh the image of the company in a new way, just to make sure that it does reflect the current expectations out in the market. It reflects what people are excited about and willing to pay big money for. This is a reason why you see a lot of these things. So this is something to keep in mind as you go through an exit itself as well. And the last part, like I said, is just focusing in on also building relationships with potential acquirers early on, just so that you can have them in mind. They can get and have ample time to know and study the company that you're invested in order to potentially be persuaded into an acquisition later on. Now we're going to jump into the investment case study, but before that, if there's any questions, I can.
Yeah, just a reminder, everyone, that is right now in the LinkedIn live, that you can post your questions there. I will be able to see them, but if you want to post it later, then we answer, by text message. But we can continue, Alejandro.
Okay. So in today's case study, basically, we're going to look at a very, very simplistic example. This is a hypothetical investment case study. So the company that we're going to be looking at is MedTech Innovators. They're going to be in the healthcare technology sector. Now, this is assuming that we've invested already in this company $5 million for 20% stake at a $25 million post-money valuation in a Series A. Now, the current stage of the company is that they're considering or launching their Series C round. Now, in order for us to make our follow-on decision, the first things that we're going to be looking at is the company progress. So in this case, revenue growth has actually gone from $1 million to $10 million ARR in 2 years, which is very good. Market expansion, they've entered into 3 new countries, and they've also launched 2 new product lines, which has essentially powered all of this new revenue. Now, the proposed investment that we're considering, and this is to maintain our existing ownership stake, is $50 million at a $250 million pre-money valuation. Now, the decision factors here, obviously, we have strong execution and market traction, but we're also seeing increasing competition from well-funded rivals, meaning that other companies are coming into the market because it looks like an attractive segment of the industry. But at the same time, because the company that we've invested in has been in there for a while, they still have good potential to maintain the market leadership and continue being a top performer in it. So in this example, obviously, just for the purposes of the exercise, we're assuming that we are going through with the follow-on investment. But before, essentially deciding whether to go through or not, we're obviously considering what are our exit scenarios look like at the current stage of our investments. So scenario 1 is an IPO in 2 years at a $1 billion valuation. Again, looking at, for example, existing multiples out there. The scenario number 2 that we think it's realistic is potentially an acquisition by another healthcare giant at $750 million in 3 years. And scenario 3, we would be okay with selling 50% of our current investment to a growth equity firm, so another investor. And again, the considerations that we would have to have in this scenario is, what are the market conditions? What are other comparable exits right now in the marketplace? Basically, is the market trending upwards or downwards? And are we getting appealing prices for these types of companies? Number 2, obviously, the company's growth trajectory, which we've discussed. So which is, does the company still have potential to grow? In the past, they've been able to show growth, but is that growth still applicable in the current landscape? And same for capital needs. Obviously, this is a huge round. But then, besides this round, in the future, is there going to be more capital requirements, or is this going to be one of the last investment rounds as part of the pipeline of this company? And obviously, the number 3 is our own life cycle. So what are our expectations? Do we need to exit this investment in the next few years, or can we still wait for a couple more? So again, here, all of these things could be at play. So just something like that would go through a traditional that would go in a traditional investment process as a consideration for a follow-on decision. But in this case, like I said, we are assuming that we're proceeding with the investment, follow-on investment, just so that we can look at the return analysis here later on. So, like I said, the initial investment that we had is $5 million for 20% stake. Then the follow-on investment, out of the total round, we're looking to invest $10 million out of the 50, and this we're doing so in order to maintain our 20% stake. So this meaning that our total investment right now is going to be at $15 million. So this $15 million basically in terms of the return analysis for the scenarios that we discussed, looks in a few different ways. For the IPO, it basically represents 3.3 money on investment. In other words, a $200 million return. Then the acquisition represents a 10x scenario with a $150 million return, and the scenario 3 represents a 5x scenario. And this is only for half of the stake for a 37.5 million partial return. Now, the question is always, well, what's the best scenario, right, that we should be aiming for as an investor? And in this case, again, the purpose of this exercise is really to show you that there's no ideal scenario. In this case, right, all of these different scenarios will give you way more than your initial $15 million in terms of investment. So all of these scenarios could happen, and all of these scenarios are equally as valid, but it all depends on the situation that you're on. If you're in a position to wait, for example, then maybe you can proceed with scenario number 3, in which you generate already 5 exit on 50% of your stake, and then still have 50% of the remaining stake, so 7.5 million that you can keep for an additional set of maybe 5 to 10 years, and wait for that to appreciate even more, right? But this is only if you actually have the luxury of time, for example. And scenario number 2, for example, is a very, very good scenario, especially in situations in which maybe the IPO market, for example, is not appealing at all. Maybe valuations are tanking. Maybe the economic environment overall is not good. But still, an acquisition by somebody that's strategic, meaning that they're in the same industry, they understand the value of the company, they're not going to come in necessarily and lowball the investment that you've generated, but obviously maybe it's still going to be at a lower valuation that you could have gotten from an IPO, but still a very, very decent return, right? 150 million out of 15 million is not bad. And then scenario 1, again, this is only if you actually strike the luck to, number 1, be in the company long enough that you reach that scenario, right? And be basically in the right place at the right time, meaning that by the time that you decide that, hey, maybe this company is ready for an IPO, the economic environment actually allows you to have a very fruitful transaction in that scenario. So again, all of these scenarios paint a very, very, very different picture in terms of returns. So there's no real, what's the best scenario here. There's no good or bad answer. It will always depend on your situation as an investor, the conditions that you're in, and basically what you can actually tolerate or what's feasible also for you. So that's basically what we wanted to leave you with here as a message. If there's any questions, please feel free to enter them in the chat. Otherwise, we'll be happy to answer them later on.
Yeah, no, thank you, Alejandro. And that was a very, very good, amount of information about the different type of exits that people can think. Sometimes people think like, IPO should be the exit, or, M&A can be the exit. But really is what you said, is when, things and the right moment is for you to actually exit from, that particular deal. So I hope that this information was good for those that are right now in LinkedIn. I haven't seen any questions so far, but I know sometimes people are posting later, so we will keep an eye on that. So I would like to thank you everyone for joining us during the last 2, webinars. We were completing the information that we had during the Launch and Learn in Toronto Tech Week. And Alejandro has been wonderful as always, passing this information for everyone. In the meantime, guys, I encourage every single new member to just join our newsletter for GSA Ventures. We will continue passing information that is relevant for pre-seed investors. Thank you, everyone, and have a wonderful Friday today. See ya.
Thank you, guys.
And